Hello traders. In this video, I will tell you how to use one of the most complex, yet one of the most famous technical analysis indicators. I'm talking about Ichimoku Clouds. It is a system of several complex moving averages that are not calculated using standard moving average formulas. Some of them include volume indicators, some of them are shifted from the current movement with a flag to screen out signals. And I won't go into detail in this video about exactly what formulas are used to count each of these lines, what formulas these indicators use. I want to share more practical information on how to use this indicator to find signals and to make profitable trades. At first glance, the indicator seems to be very complicated. If you add it to the chart, it will look literally like this. And a beginner at this point may think that he will not be able to cope with this indicator, that it is too complicated, and so on. In fact, Ichimoku indicator laid down simple basic principles of trading, simple basic principles of finding trends. In particular, moving average crossover systems and so on are used here. But how good is Ichimoku indicator? Unlike MACD, Stochastic, or other indicators that can find momentum, the Ichimoku indicator is a universal tool that not only helps you find a good moment to enter a trade and a good moment to start a trend, but also has in its arsenal several tools to cut off filtering signals. And I will talk about each of them in this video. But just so you understand, the Ichimoku indicator is one of the few technical analysis indicators that can be used without other tools. Only literally one indicator to help you find profitable trades. So let's start with the basics. The indicator consists of 5 moving lines, 5 lines, each of which is responsible for its own separate area. Let's take a closer look at each of them. For this purpose, we will remove unnecessary lines from the chart. For example, these 3 lines here and leave only 2. At the convertation line, Iba's line. And from how they look on the graph, the system has become much simpler. Now we just see 2 moving averages, one fast moving average. We have it in blue. This is the so-called conversion line. And the red line, which is slower, the baseline, is set a little behind the chart. And we have the red line acting as a slow moving average. The signal for entering trades only with these 2 lines is the same as in the classical scheme with standard averages. When a fast moving average crosses a slow one from top to bottom, it is a signal for a downward trade. As in this case, this means that the faster, more responsive moving average is now lower than the one that is slower. And it shows us that in the moment, we have the prerequisites to create a bearish trend and vice versa. Like in this case, when the fast moving average in our case crosses the slow line from bottom to top, it tells us that we have a good moment to enter the trade. How exactly does this system of these 2 lines differ from the usual moving average strategy? Because the blue line is built according to the rules of a regular moving average. And the red line here is constructed using a much more complex formula that also includes offsetting from the chart with a slight run ahead. And it's also not built by averaging the lows. It takes into account the highs and lows of the chart. And that allows us to be a little more responsive to schedule movement. But if we summarize the information on these 2 lines, the signal is very simple. The crossover, when the fast line crosses the slow line, in which direction it crossed, in that direction, we open a deal. Let's now talk about the other 2 elements of the chart. This is the so-called Ichimoku Cloud. The cloud is called Kumo from Japanese because the technical indicator was invented first in Japan, began to be used by Japanese traders. These are 2 different lines that are built by very different rules. They, in this case, also include trading volumes. And the cloud shows us 2 things. First, it shows the direction of the graph. The color of the cloud shows which direction the chart is moving on average. Even by color, we can tell that in this case, we are in a downtrend, and in this case, an uptrend. The second thing the clouds show is the strength of the trend and the volume in the market right now. The wider the distance between the lines and the wider this cloud is, the higher our trading volume and the stronger the uncertainty zone in the cloud. But in the context of the cloud strategy, Kumo is used not to find entry points, not to react to signals, but to filter signals by the first two moving averages. The general rule of thumb is that if the chart is below the Kumo Cloud, it means that we only consider trades downwards. In this case, no matter how the lines cross, we will only look at the signals that give us a down trade. We're only looking at whether it's higher or lower. In this case, the chart above. So this is the area where we will only look for signals for upward trades. So putting our lines back in place, the overall strategy looks like this. We add conversion line and baseline and leave the Kumo Cloud. The general strategy looks like this. We look for signals on the two baselines on the blue and red lines. We wait for their crossing. This is a basic signal for us to enter the deal, and we also filter the signal by the cloud. To confirm a down signal, the chart must be below the Kumo Cloud. And to confirm an up signal, such as here, the chart must be above the Kumo Cloud. And also, all the signals that appear within the cloud itself, we miss. That's what this signal is like, for example. This is exactly the filtering tool I said it was. The indicator itself is trending, and it does not show itself well in a state where we have a flat market. And so all the deals that are inside the cloud, they're just going to fall into just about these kinds of ready-made areas. We just skip them because most of them will be inaccurate. In the specific case at hand, we can only use one transaction. We see a crossover between two moving averages. The fast moving average crossed the slow moving average from top to bottom, and the chart itself is below the Kumo Cloud. And now we enter this signal and make profit on this whole movement. Let's look at an example of a reverse transaction. In this case, the trades are up. We are looking for the crossover point where the fast moving average blue crossed the red line. That's the base signal for us. And we also look for the chart to be above the cloud. In this case, this signal is confirmed, and we get profit on this whole long trade. You may also notice that there's also a fifth line in the Ichimoku Cloud, which is called lagging spam. It is marked in green. We can turn it off or turn it on. What is lagging spam? It is an alternative tool to filter the signal. It is a moving average that takes into account not only the average movement, but also the maximum and minimum points. And it is shifted up or down from the chart depending on the direction. Many traders use this line, some don't use it at all. Many limit themselves to the clouds and the two major moving averages. But I'll show you how to use lagging spam in your strategy when we want to confirm or deny a signal. Here, for example, is our signal, which we have already considered. The lines have crossed, they are above the cloud. We're using an upward signal. We can use lagging spam as an additional confirmation if it is rising. If the chart is in a rising state, this is also an additional confirmation of the chart. And if, on the contrary, it refutes our signal, it says that the trend is already fading, and we cannot use such a signal as, for example, if there was a crossover here. This is a similar situation to the intersection. That is an additional signal, we could use it. There's an intersection, it's above the cloud. We could use it, but we see the lagging spam dropping at this point. And indeed, the trend, as you can see, has begun to fade. Lagging spam shows a little ahead of time, exactly when the trend will start to fade or go into corrections. So let's take another look at how to use the strategy using just a regular chart as an example. Here we have scrolled it, just looking at the chart and waiting for the signal from the moving averages first. Here we see that, first of all, we have a crossover from the top to the bottom. This is a signal for a down trade. But since the chart is above the cloud, we miss this signal. After that, we have an upward signal. The fast moving average crosses the slow moving average from the bottom up. And this is the signal for an upward trade. The price is above the cloud, and we use the trade to enter the chart. Here we see another intersection that we can't use because it's above the cloud, so we skip it too. Let's move on. The graph goes into the Kumo Cloud. Even if there was a moving crossover, we would just miss it, as it falls into the cloud area. Let's see how the situation develops further. We see the crossover again. The fast-moving average crossed the slow-moving average from top to bottom. This is a signal for a trade down. And since our chart is in the area below the cloud, we use this trade down and so make a profit. Let's check the same signals using an additional filter in the form of lagging span. Let's add it to the chart and see what we would get in this situation. We see that overall, lagging span is growing. There is a slight correction here, but overall, the general trend is up, and we are confirming our upward signal here. And in this situation, when we see a crossover and we have a down signal confirmed by all indicators except lagging span. In this case, the lagging span is increasing, and we would have missed such a signal with this strategy. And indeed, we would have made a profit here. We would have missed a good signal, but the trend here isn't really that strong. And for conservative traders who don't want to take a lot of risk in their strategy, I recommend adding that green line. It will filter you out, kind of good, but borderline signals. And if you confirm signals using both Kumo Cloud and lagging span filters, you will get quite few signals, but their quality will be very high. And I will remind you that the higher the time frame you will use, in this case, 15 minutes, the higher will be the quality of your signals. So the Ichimoku Cloud is a universal indicator, which simultaneously gives signals and can filter them. Simultaneously shows the strength of the trend and the market volume, and a lot of different indicators, which we can literally, with one tool, find on the chart and use for our trades. I recommend you to try this indicator, especially if you are a conservative trader who is not looking for a lot of trades, but looking for good trades. And also, one more very important point, that this indicator not only helps you to enter trades, but also to exit them at the same time. In this case, the main strategy is to place stop losses on the upper boundary of the cloud. That is, if we used a signal, we place a stop loss on the upper boundary of the cloud and move it along with the cloud. That is where we make a profit on the chart and move with it. And at this moment, we would have fixed profit because the chart hit the cloud and our stop loss was triggered. But at that moment, we have already received a very good profit from the deal. And this is the tool that shows us that the trend is already reversing and it is time to fix the profit on the deal. Therefore, clouds can be used not only to filter signals or to estimate volumes, but also to manage stop losses on a trade. And in general, this is a very simple strategy, which fully combines all the necessary tools for a trader. So try it, share your successes in the comments, and see you soon.